Have you ever wondered how banks have the ability to loan out more money than they physically possess? It's an intriguing question, isn't it? The secret lies in a little-known banking principle known as fractional banking. Simply put, this principle allows banks to lend out a multiple of the money they hold in their reserves. Here's how it works. When you deposit money into your bank account, the bank doesn't just keep it all in a vault. Instead, it keeps a fraction of your deposit and loans out the rest to others. This system is what enables banks to generate loans that far surpass the actual cash they hold. But you may be asking, what happens to my money? Well, your money is safe and accessible, but it's also working hard behind the scenes, enabling the bank to lend more and drive economic activity. So how does this economic magic trick affect our economy? Let's dive deeper. Imagine a domino setup. A small push at the beginning can trigger a large reaction. This is similar to fractional banking. Let's dive into it. When you deposit money in a bank, only a fraction of it is held as reserve. The rest is loaned out. This loan then becomes a deposit for someone else, and the cycle continues. Each time, the bank holds a fraction and loans out the rest, creating more money than was initially deposited. This is the power of fractional banking. It's like a chain reaction, where a small amount of deposited money can lead to a larger amount of loans. And these loans? They stimulate economic growth. They provide more funds for businesses to expand, for individuals to purchase homes, cars, and other goods. This domino effect of money creation through fractional banking fuels our economy. But as with all things, there are two sides to this coin. And what happens when the dominoes stop falling midway? Just as with any system, there are inherent risks within the mechanism of fractional banking. Picture this. If a large number of people suddenly decide to withdraw their deposits, it could potentially trigger what we call a bank run. This is a situation where a bank is unable to fulfill its obligations, leading to a ripple effect of financial instability. Moreover, if banks lend out too much without maintaining an adequate reserve, it could put them at risk of insolvency. This is where the delicate dance of fractional banking comes into play. While it can serve as a powerful engine fueling economic growth, it can also, if not properly managed, lead to economic instability, much like a car engine running without oil. We must remember, though, that with great power comes great responsibility. So the question remains, so is the risk worth the reward? It's a delicate balance that our economy must strike. Fractional banking, an economic double-edged sword. As we've seen, this concept is a foundational cornerstone of modern banking. It's the mechanism that allows banks to lend more money than they physically hold, effectively creating new money and fueling economic growth. But like all tools, it's not without its risks. The domino effect of fractional banking can lead to financial instability if not managed properly, as we've seen in past economic crises. The key takeaway here is that banking, like any other industry, operates within a delicate balance of risk and reward. Understanding these financial mechanisms can empower us to make informed decisions about our money. It can help us navigate the complex world of finance with a little more confidence and a lot more knowledge. Now, the next time you visit your bank, you'll understand the unseen power at play. Until next time, stay curious and keep questioning.